special show on ET Now. The banking sector scoreboard this quarter tells a tale of contrasts. Some lenders are stepping on the gas, others are slamming the brakes. Advances and deposits are growing at a steady chip, but shrinking margins, rising provisions, and sticky slippages are clouding the picture. And a new trend is emerging: rising stress in the microfinance segment. Are these just passing speed bumps or early signs of a deeper trouble ahead? Let's decode the numbers and the narrative, and I have with me a whole host of experts. We are joined by Tamal Bandyopadhyay and Dhananjay Sinha to discuss these Q1 numbers. But I'll come to you, gentlemen. Before that, let's go across to our colleague Varun, who's giving a roundup of how the quarter has been so far for both PSU as well as private banks.
Definitely. So it's been a very interesting quarter for the overall banking sector, wherein if you see the overall report card of the banking sector, it has been mixed, wherein the overall credit growth has been low, the deposit growth has been low, also there has been increasing NPAs, the names have contracted this quarter, and also increasing provision and slippages has been a story of majority of the private banks this quarter. But more than this, every bank had its own story. So let me start with the overall private banking sector, wherein if you look at the big banks, the overall growth has now come to around single digit or around low double digit for majority of the banks. For likes of HDFC Bank, the NII growth has been around 5.4%, the profit growth has been around 12%, and for majority of the banks, if you look, there has been an overall decline in net interest margin to the tune of around 10 to 30 basis points. Also, if you look at the overall gross NPA numbers, there has been an increase in the overall gross NPA numbers. That means the overall asset quality for private banks have deteriorated to the tune of 10 to 30 basis points. Also, the provisioning and slippages for majority of the banks, for majority of the private banks, have gone up. No doubt, HDFC Bank had its own story of floating provision. Axis Bank had its own story of technical, adjustment that they have done. Other than that, if you look at the overall commentary of these banks, majority of the commentary of these banks was subdued. For example, HDFC Bank highlighted about the stress in the MSME segment. Kotak Mahindra Bank, they highlighted the stress in the microfinance segment and also the CV space, which has actually impacted the overall net interest margins for this bank. Now, if you come at some of the small banks like Bandhan and RBL, over there, the loans and advances, they have grown in single digit, although the deposit growth has been better than what you have seen in some of the big banks. But yes, the profit have declined from around 46 to 65%, and also the net NPAs have gone up, provisioning has gone up, and slippages have all gone up for these banks. Also, if you look at for banks like Small Finance Bank, AU Small Finance Bank, the overall growth has actually come down. Now, if you come to PSU banks, the overall growth for PSU banks have been better than what you have seen in private banks. For example, the loan growth, the deposit growth, they have been in double digit, although they have been in low double digit, but yes, there's a double digit growth which they have actually given in this quarter. The overall net interest margin for these banks have declined less than compared to private bank, and also the asset quality deterioration has been less than what we have seen in majority of the private banks. So it has been a private versus PSU, wherein majority of the PSU banks have outperformed the private banks. And let me tell you one thing, that every bank had its own story, especially on the private banking side.
Yes, definitely. Thanks, Varun, for that roundup. And there are many stories if you talk about the banking sector results, because on one side, one bank is declaring that MSME stress is there, and on another side, so for example, IDFC First Bank, they are saying there is no stress on MSME. But to decode what is the real answer, I have with me Tamal Bandyopadhyay. Tamal, hi. First thing first, where is the stress you are seeing in the banking sector? Because each bank is telling their own story. I gave example of IDFC First Bank where they are saying there is no MSME stress, while if you see Axis Bank and other banks, they have said that yes, MSME there is a stress.
Well, I think your colleague summed up pretty well. Each bank has its own story, and that's the one liner. And second part of what he has said is this: comparatively, public sector banks have done better than their private counterparts. That's the thing. Other part is, I'm not very sure because I don't know how to be diplomatic. I think we need to see and we need to believe and disbelieve certain numbers. And so it's wait and watch because again, I'm not casting any aspersion, but in the same segment, if one particular entity says that everything is fine and others, many others say no, everything is not fine, then we need to figure out then, which means the business model of all the others are not that good, and that particular entity which is not finding any problem, it's everything is fine with them. Or it's the other way, we are not telling what exactly is happening. So it's your guess is as good as mine. I think we need to wait and watch, but for the past few quarters, we have been flagging off issues that things are, I mean, banking sector is holding on, everything is fine. There is resilience in the balance sheet, and but that's the but part is this: there are slippages. There is certain pockets where not so happy scenario. I think it's now playing out, but we don't get to see much because you see, particularly for the sector bank in the certain segment, personal loan, etc., because the NIM is so high, they can afford to write off very fast, which other banks like public sector banks can hold on. So what we see on the quality of assets actually don't give us the exact scenario. Probably it could happen is this bank A or bank B. They have certain issues are there, but they are pretty fast in cleaning up. They can afford to do because their margin is so high. So I think we need to read between the lines and we need to keep a close watch how things unfold.
All right, we also have with us Dhananjay Sinha joining in. Dhananjay, hi. We were discussing about stress in the banking sector, and there's a different story of banks. That is the bottom line which we are discussing. While on one side, MSME, there is a debate, but MFIs, we have seen many banks who have actually declared that MFI is something which they are watching. We have Kotak, we have also seen in IndusInd Bank case and other banks, they have said MFI stress is building. So what is your sense on this problem per se, on stress building in the banking sector and any other sector other than MFI you are watching?
So I think if you look at the banking sector over the last, I would say 4 or 5 years, we haven't seen that kind of growth as far as the corporate lending is concerned. And that is largely because the corporate sector has seen a significant improvement in balance sheet situation, EBITDA expansion, cash flow situation, all those things have happened. So that part is kind of fairly safe, I would say. And if you look at the current scenario, also the growth is very limited. So I think that part is not a big bother for the banking system. I think the major kind of growth that has happened is largely led by the retail lending. And I would say that there was a considerable amount of buoyancy in the uncollateralized lending that was happening, and RBI was kind of bothered about it. And they had taken some tightening actions till 2023, I think somewhere around November 23. From there on, I would say they sort of started to tighten as there was exuberant retail lending. I would say that part is something that we need to be watchful about, because what I am concerned about is the leverage that households have actually taken. And this is happening across regions, including metropolitans, urban areas, and semi-urban and rural as well. And we have seen in rural areas also the lending growth on the retail side, if you look at the annual data, looks like growing at 18%, much higher than the economic activities-led lending in the rural areas as well. So that part needs to be looked at. As far as the MSME and the micro the MFIs are concerned, there I would say that problem has been there for quite some time. It's been for several quarters now, and I think it is engulfing more and more better quality banks as well. So I think the results that we are seeing has seen that part accentuating. As far as MSMEs is concerned, a lot of these banks, even if you look at ICICI Bank or HDFC Bank and the top-notch banks, if you look at that, they have been growing on business banking, and that is the portion that has been growing more rapidly as a system on a systemic basis than other parts. So I think that part we'll need to really look at, and we have to really see why there has been a considerable slackening in the overall corporate lending while the MSME is actually rising. So this is kind of very counterintuitive. Our sense is that this could be because of a tightening cash flow situation that might be happening because larger companies are conserving cash flows, etc. So we need to really look at that. So I think that can be the next level of monitorable that one needs to look at it. Overall, I would say that banking sector lending growth has slowed quite considerably. Incrementally, if you look at the lending that banks have done at a systemic level, is at least 30% lesser than what they did a year back. So I think when a slowdown happens, there is a sort of inverse relationship between the NPA ratios or the credit cost versus lending growth. It looks like despite the fact that RBI has eased the monetary policy rates and eased liquidity infusion is very high, lending growth has not really taken off. So my sense is that banks might actually see NPA ratios rising. We are seeing that in the results in the current quarter. It could actually increase going forward. We'll need to be mindful of that. I think the other aspect is that because of the low demand for credit and the fact that RBI has cut rates quite significantly and infused liquidity, the margin pressure for the banking sector might actually continue. I see that a lot of banks are struggling with that.
Definitely. So the margin pressure are going to be there in coming quarter as well. But Mr. Tamal, this is one Varun this side. Just wanted to understand, because it was a year ago that we heard that the overall pain in the microfinance segment would be for 2 quarters. After 2 quarters, we heard that yes, it's going to be for more 2 quarters. But now if you look at some of the commentary of some of the banks, they are now saying that might be for the whole FY26 you will see the overall pain in MFI segment. So when is this segment actually expected to rebound and come out of the overall stress that the segment is seeing? Is it going to be 2 quarters, a year, or it will take longer than that?
Varun, I wish I had the answer. But this MFI problem or crisis, quote unquote, whatever you call it, has actually entered a new phase at this point of time. Till recently, we are talking about the stress in assets. But now what is happening is that there is a liquidity crunch. If my understanding is correct, definitely I would not name the entities, but there are a few instances of smaller MFIs. They have already defaulted in paying their bank, paying back to their banks, and this will increase because most of the banks have closed the tap. They're not giving money to the MFIs. That's the problem. Now, if I'm an MFI, I largely depend on the bank money. And if the bank stop giving me money, then what happens? What happens is this: I focus on recovery, and that the recovered money, if it's not that much, I cannot build my book, I cannot expand my book, and the moment the bank close the tap, I'm in a sort of mess. So not every MFI can withstand this kind of pressure. It's a new pressure. On the positive side, things are looking up. If you see that the quality of assets, the so-called PAR 1 to 30, 30 to 60, where the people are ability to pay, they are not paying, etc. It's actually getting better. A quick number I have on my table, like for instance, PAR 1 to 30, people are not servicing their loan up to 30 days, which was 2.1% in September 2024, now just come down to 1.6%. Similarly, PAR 31 to 60, which was 1.5% in December, now has come down to 1.1%. PAR 61 to 90, which was 1.6% in December, now it has come down to 1.3%. But on the longer side, if you see 180 days PAR, where people have not paid 6 months or more, it continues to be high because they're the historic portfolio those guys are keeping in their books. It could be as old as during the COVID period happened, even before that. And these are all been provided for, so not to worry on that. I don't know why everybody has not written up, but the credit bureau data continue to have that. So the good part is this: the quality of assets is getting better. Not in absolute great health, but is getting better. Second part is this: they're more circumspect. the association to association, they are putting up guardrail every second day. They are tightening the norms. So the MFI industries are not giving
Right.
loan to more than 3 entities, not beyond 2 lakh. All these issues are taken care of. But if the banks do not open the tap, then I think there is some serious issues we might see. We might see more defaults, and
Definitely.
things can get messy.
Definitely, Tamal. A valid point raised here, but these are just one part of the many questions which we are asking Varun. It's time to take a very quick break, but after the break, we'll address, is PSU banks having a better party than private banks? Also, what is the scenario for advances and deposit growth? Is it in line or below expectations? We'll all discuss about it after the break.
Welcome back to ET Now Insights. We are having a discussion on how have been this quarter for the overall banking sector. And let's go ahead. And one more question is one, Ankur, that how has this quarter been for private banks versus the PSU banks? Because there is a debate that PSU banks have actually outperformed the private banks. Let's ask Mr. Sinha. Mr. Sinha, what are your thoughts when it comes to a comparison between the private banks and PSU banks? Have PSU banks actually done better than the private banks, or the pain is yet to come to the PSU banks in coming quarter?
So I think the overall banking system hasn't grown much, and I think there has been a slowdown that's been happening. And I think there has been a good amount of deceleration that is happening also for the PSU banks. So if you look at it, a lot of infra spending that was happening from a government side, and there was good amount of sanctions that were happening for project lending and all. And there has been a slowdown, and I get a sense that there has been a sort of slackening in the cash flow around those projects as well. So I think the growth slowdown is there for the PSU banks as well. I would say that, with respect to the credit to deposit ratio, they are at a much lower level compared to the private sector banks. They would be in the region of roughly about 74-75%. I would say, hence the moderation in the CD ratio that is required for the normalization of the banking system is somewhat lesser for them. But I think the important thing for the PSU banks is to understand that in the last cycle they had benefited a lot by way of write back of provisioning, and that translated into a one-off expansion in their profits because of those variables. I think that is coming off as a result of that.
All right, Mr. Sinha, due to paucity of time, we have to continue this discussion in other time, and actually results are continuing, and so will our discussion will continue on banking sector. Thank you so much, Mr. Sinha and Mr. Tamal Bandyopadhyay, for joining us on ET Now Insights. And with this, it's time to take earnings update on Asian Paints, and I have with me Mansi for that. Mansi, over to you.
Absolutely. Thanks for that, Ankur and Varun. There were many factors which we had to take a look into, right coming from the volume growth scenario, which was expected to be around 3.5 to 4%. As we have the numbers, and the stock is also reacting with 1.5% up, move 2399 to be precise. Taking a look at the figures, and of course, there are other few things which are in focus, the management commentary, what the management say, the demand outlook as well as the gross margin trends. But the MD, the management is confident in long-term growth potential, as we clearly see. The Q1 numbers are out, and along with the numbers, the management commentary one by one, the numbers are also coming in. 1100 crore is the consolidated profit figure which we see as versus the 18-hour poll, which was 1101 crore. So near around to what our estimates were. Our estimates were 1101 crore, 1101 crore, and the profit figure has come at 1100. The consolidated revenue is at 8939 crore. The margins are around 18.2%, which is exactly what we were expecting. And at the same time, if we see, there are a few other things which we need to take into consideration while we are talking about the Asian Paint. And in particular, the energy pack and the crude related factor also plays big for paint and cement players. As we see, we clearly have 0.3% year-on-year increase in the revenue front. The decorative as business segment performance is also there, and the pressure on household income has hurt the home decor business. These are the highlights coming in. On the face of it, the margins are 18.2% from 19%, which is a slight 70 basis points downtrend. The EBITDA is around 4% down on a year-on-year basis, 1624 crore. And also, if we talk about the stock performance, around 1.5% to 2% gains. Clearly, we have Gaurang Shah with us, who will help us decode the numbers and talk more on what is his views on Asian Paints. And we also have Amnish Agrawal joining with us. Amnish and Gaurang, thank you so much for giving your time to ET Now. On the face of it, as we see, we have the revenue figures, the margins figure, which have seen basis points but slight decline. But the stock is reacting on a positive front. Gaurang, I'll start with you. Your first take on the results.
Thank you for having me on the show. So, little bit of improvement compared to what Asian Paints has done in the last financial year is what is visible. But we need to have a little bit of more clarity in terms of the management commentary. Competition is quite high, especially from Oppo, and other unorganized sectors also have been quite competitive in the market. In fact, Oppo has gained market share, if I'm not mistaken. That's what I read in the report about a week back. Needs to be seen as to what is the contribution in terms of decorative paints, which is a high margin product.
Revenue figure has come at 8939 crore. Amish, good afternoon to you as well. Yes, your first take on the numbers, and at the same time, do you think the early onset of monsoon is a trigger which will impact the demand for paint stocks and in particular Asian Paints moving ahead as well?
You see, the weather patterns are becoming very volatile, and this is not, you can say, current year's phenomena. So in the past also it has happened, because 1Q seasonally has become very important from the paints viewpoint, in addition to the festival season which comes post-October. Now, if you look at this particular quarter, you had some disruption in North India due to Operation Sindoor also. And you had this uneven pattern of weather. But if you look at last year, 1Q was impacted because of elections. So the base was not that high, I would say. So on the base where your top line actually had declined last year, so this year is not showing any appreciable improvement. Yes, there could be some gains which might have been there due to your benign crude prices. But overall, you can say that the extent of decline we have seen in the past few quarters, now the decline is in low single digits. But definitely, you see, scope of improvement is there, but difficult to say whether we are out of woods and now you will be back to high single digit or double digit profit growth.
Along with it, we also see the international business, which is in an uptick of around 8.4%, and at the same time, the management commentary is also constantly running. Gaurang, one more thing, the home decor segment. The segment has seen some signs of volatility. Do you think the household disposable income and the scenarios which are panning out these days as per the economy, and particularly in the urban market, is hurting the sentiment for the home decor segment?
It definitely looks like, and this was visible even in the last quarter. According to us, well, the green shoots in terms of consumption, discretionary, non-discretionary picking up would possibly be visible in October, November and December. That is around third quarter this financial year. Urban demand needs to improve. Yes, market share needs to improve. In terms of detailed management commentary, I think that will help. But the problem is high-end competition, whether they are able to survive that and keep the margin afloat. I think that's the big question, and it's not seen at least in this quarter.
From both of your market experts, I would just want one view for our market participants who already have their positions in Asian Paints. Amnish, we'll start with you. What will be your view for the participants and market viewers who have their positions at present in Asian Paints? The stock is around 1.5 to 2% up on the back of the results.
You see, we have a reduced rating on the stocks. We will review our numbers, but I don't think that there is a big case for change in the view as of now.
Scorecard also mentions the same. The margins have seen a dent, the revenue front and as well as the profit figures. Gaurang, what will be your view on Asian Paints?
Well, so before I give that, disclosure needs to be given. All recommendations are part of our research team. Our company, Jyojit or I, do not have any personal investments, no financial interest also, no conflict of interest either. but we give similar recommendations to our clients. They might have the position. So our research team has given a reduced stroke sell recommendation on Asian Paints.
Okay, Gaurang and Amnish, thank you so much for giving your time and helping us with your views on the paint sector and in particular Asian Paints. So Asian Paints post the numbers. We see an an upsurge of around 1.5 to 2%, but the numbers on the flat front, the revenue is flat and at the same time the margins and the profit figures have seen concerns. On that note, we slip into a short break. While we come back, we will open with the closing trade.